Hello. Good afternoon. We're going to get started. Hi, everyone. I'm Linda Hammes. I'm the publisher of Foreign Affairs Magazine, and I'm thrilled to welcome you today to the Cryptocurrency Policy Forum. All right. Who was that? Thank you. Focus today will largely be on Bitcoin, though much discussion about regulation will apply to other digital currencies. Bitcoin. Bitcoin has been proclaimed as the most powerful innovation in finance in 500 years. It's been called the Internet of Currencies. It has been said to be a revolution that can change millions of lives, including in the developing world. Detractors denounce Bitcoin for its volatility, saying it should be thought of at best as a commodity and at worst as a bubble or even a Ponzi scheme. It has been blamed for facilitating illegal markets, cybercrime, even kidnapping. Yet others have debunked Bitcoin as a financial service, but praised its application as an internet protocol to solve other global problems. No matter what, our speakers, and many of you experts in the audience too, are bound to engage in a highly relevant topic of debate today. In fact, one of our speakers today was called away to present to President Obama's team in preparation for his speech at Stanford. Woo! I think we need some more of those woos. Feel free. Yeah, thank you. Yeah. So our goal here at Foreign Affairs, as always, is not to espouse one view or another, but to increase knowledge and discussion about regulation of the blockchain technology and to shed light on the public policy debate around Bitcoin. Some order of business. Please, I don't want to have to say it again. Silence your phones, but feel free to keep the Twitter conversation going at #FALive. FA Live. This event is on the record. There will be Q&A sessions at the end of each of the 3 panels. If you're called on by the moderator, please stand, wait for the microphone, state your name and your affiliation, and stick to one question and make it concise for the rest of us. Thank you. Without further ado, let's begin and get started on the first panel, The Future of Payment, which will focus on the mainstreaming of block technologies, including the question of regulation. Our moderator, he will be recognizable to many of you, Jerry Brito, the Executive Director of Coin Center. And our other esteemed panelists include Karen Gifford, Chief Compliance Officer at Ripple Labs, Patrick Merck, Executive Director of the Bitcoin Foundation, and Anne Shear-Walwork, Senior Counselor for Strategic Policy at the U.S. Department of the Treasury. Jerry, take it away.
Thank you so much. Thank you all for coming. Just to start off by telling you a little bit about Coin Center. Coin Center is a nonprofit research and advocacy center. It's based in Washington, D.C. And our mission is to make sure that policymakers, the media, understand the technology, that we have the right policy research from academics and experts that's available to inform the conversation, and to advocate for the freedom to innovate on top of these technologies. So that's what we do, and so I'm very happy to have this fantastic set of speakers with us. And I thought maybe we'd begin by just going down the line and having each of them say a little bit about themselves and how they see the mainstreaming of this technology. So Anne, why don't we start with you?
Okay. I'm very pleased to be here. I work in an office at Treasury called the Office of Terrorist Financing and Financial Crimes, which is a policy shop under a wider umbrella of the Office of Terrorism and Financial Intelligence. Later in the second panel, I believe, the money laundering panel, you will have the opportunity to hear from the director of another component of that office, Jen Shafsky-Cavalry, who is the director of FinCEN. Other components of that office are OFAC, the Office of Financial Asset Controls, which is the sanctions implementer for the U.S. government, and an Intel shop, the Office of Intelligence Analysis. And I should add here that I speak for myself personally and not for officially for the Department of the Treasury.
When does anybody ever speak officially for a federal?
Well, And the mission of our policy shop, TFFC, is to identify systemic risks in both the domestic and international financial system and develop strategies to mitigate those risks. We work extensively internationally, including through the Financial Action Task Force, which is the international anti-money laundering, counter-terrorist financing, and counter-proliferation financing standard-setting body for the global financial system.
Great. Patrick?
Hi, thanks for having me. Patrick Merck, I'm Executive Director of the Bitcoin Foundation. Bitcoin Foundation is a nonprofit. Our mission is to fund research and development into Bitcoin Core and to support the Bitcoin Core Development Project. So our chief scientist, Gavin Andreessen, who chafes at this but is sort of like the Linus Torvalds of Bitcoin, was able to join us, so thanks Gavin for showing up. If you really have real questions about Bitcoin, you should probably ask him, not this guy. But he was smart enough to sit down there. As part of our mission, so we fund the research and development into Bitcoin Core, and we provide new avenues for people to contribute to the Bitcoin Core software development project. So from our perspective, there's this emerging new digital economy that's forming. And to really inform that and make it open and participatory, making sure that things like Bitcoin Core are well supported is probably the best way to achieve that goal, to make sure that that new digital economy that's coming down the pipe is open, is participatory, it's free for everybody to be involved in. Whether that ends up being backed by Bitcoin or whatever coin down the road, this project will at least, at a bare minimum, keep things honest. And one of the interesting things about Bitcoin, when you think about all the different systems that are at play, and you have things like Ripple, which is a neat little consensus system that's able to kind of serve as connective tissue between silos of data, financial data here and there. With Bitcoin, you have the creation of the first real digital hard asset, which, if you think about it, is kind of a weird, almost oxymoron, right? Like, wait, a digital hard asset? That doesn't make sense. But that's what Bitcoin really is on the blockchain. Some people use it as currency. Some people speculate on it. Some people use the blockchain to do completely different things. And from our point of view, there are three key components to Bitcoin and the blockchain that make the whole thing work. And that is a trusted ledger that requires zero trust from the participants in order to make transactions happen, a native token that you can use to represent either recursively itself or something else that you're using, and the freedom to kind of transact across that network. And if you have those three things, then you have a transaction system that actually works, a root level system that works. It doesn't have everything you need to maybe comply with, the travel rule or this rule or that rule or everything. But those things can, somebody's in trouble, by the way, I think, right? Yeah.
Thank you.
Yeah, you're welcome. But you can always layer those things on top. You can build, it's a building block, and you can build those things on top of the system. And you're seeing those waves of innovation happening and radiate out from Bitcoin. Keeping it simple makes sure that if I want to use Bitcoin and the blockchain for financial services, say, then I can do it. And I can layer in just in time, just what you need, identity information or things like that, and do really innovative, cool things to prevent people from using the blockchain for bad, illicit purposes. But if I want to use it for, say, voting, having identity baked in at the protocol level may preclude that avenue of innovation entirely. So making sure that there's lots of extensibility and optionality by keeping the protocol simple is something that we're very interested in, making sure software developers have the freedom to contribute to that project. So that's what we do, in a nutshell. That was the short version. Sorry.
All right.
Go ahead.
Karen.
Hi, I'm Karen Gifford. I'm from Ripple Labs. So interestingly, the private sector representative on this panel works at a company that doesn't actually use Bitcoin. We do use the Ripple protocol, which is an open source protocol similar in that sense to Bitcoin, which is also open source, but differs somewhat, and we'll probably talk a little bit over the course of this panel about some of the distinguishing features of the Ripple protocol. Essentially, it permits funds settlement from any currency to any other currency in close to real time, in 2 to 5 seconds, and close to free for about a millionth of a dollar. So we view our protocol, or the Ripple protocol, as something that can serve as a standard for fund settlement, and as such, provide interoperability between various payment networks. If you have a standard that applies to something very, very simple, like ownership, that sits sort of at the bottom of all of the various infrastructure pieces that need to be in place for a payment system to exist, that very simple standard can permit interoperability of systems that appropriately have other standards. So a wholesale payment system, for example, would have different rule sets and different risk mitigation measures than a retail payment system. A payment system that operates in one part of the world might legitimately have a very different rule set than a payment system that operates in another. But one thing that everyone can agree on is ownership, right? So we're hopeful that that the work that we do with Ripple will enable really a flowering of transactions and interoperability between systems that permit, much more economic activity, much more global, many more global transactions, and kind of the same kind of vitality that we see in information with the internet happening in the world of financial transactions. So the way that we at Ripple Labs are approaching this is through enterprise and a focus on banks and other financial services providers. When we look at how the internet started, really universities were the ones who in the beginning were the big users and promoters of the internet. So there needs to be sort of institutional players, we believe, to get something like this started, to start fairly significant change. And that's where we're focusing our attention and our efforts. Notwithstanding that, we think that these new technologies will not be limited to enterprise, but that's where it will start. And similarly to the way universities were the first places where people were using the internet, we think ultimately years from now there will be just like a vibrant ecosystem of many, many different kinds of companies, entrepreneurial, large scale, and things that we're not even really imagining now, that are engaging in many different kinds of economic activity using these new technologies.
So on that note, the purpose of this panel is to talk about integrating cryptocurrencies into the mainstream, right, to the mainstream financial services. And so we've talked a lot about how this is like the internet, how we can't imagine what's going to happen because it's an open network, anybody can build on top of it. But let's talk concretely, right? What value do cryptocurrencies, does Bitcoin, does Ripple have for mainstream financial services today? Where do you see that? So let's start with Patrick.
Yeah, so the value in the blockchain today is, I mean, in some degrees it is a little bit speculative and we are a little bit out there, right? So, but and it's interesting because you can draw a distinction between, say, the Ripple consensus network and what Bitcoin does, and trying to keep it simple here, but there are two different systems at work. With Bitcoin, you have what's called proof of work, which means that there's these miners out there, and there are people who are doing a lot of work and expending energy to make sure that transactions can occur and that they can do so in a trustless manner. So that if I want to send you some money or something of value somewhere, whatever is appended to that token, I can send it to you, and I have a certainty that it will get there, and you have a certainty that it has been, that it's yours, and that no one can double spend it, no one can take it, no one can counterfeit that transaction. And at no point in that system do I have to trust anybody. I don't have to trust a canonical ledger somewhere or anything else. It just kind of happens. And so,
Is trust a problem today?
Is trust in settlement a problem today?
Yeah.
Yeah, I think it sometimes is, but it's mediated, right? It's mediated by different institutions, whether it's banks, if it's clearinghouses, settlement companies. There are a lot of financial fiduciary trust kind of centers that right now mediate that trust out of and take the risk out of the system for people who are transacting on it, right? And allow you to kind of measure your own risk. What this does is it removes those people from the system, essentially, and allows you to to create that transaction without having to go through that third party. And that was the big innovation that happened with Bitcoin. And so what value does it have for a mainstream consumer? We're seeing, international remittances, Bitcoin used as a currency or as money or as an asset to move things from here to there. There's a lot of what's called the Bitcoin 2.0, where you're trying to attach some sort of equity or a deed or some piece of information that's valuable into the Bitcoin itself or into the blockchain and transacting it across the network. And so that's where you're seeing people starting to add value now, and where the investment is being driven is how can we take this open transaction network and build on top of it in different ways, and what's going to be the killer app thing that catches on. I don't know what that killer app is going to be yet. I don't think anybody knows, to be honest. I think there's just a wide variety of investment in different directions.
Okay, so speaking of killer apps, Karen, when I hear people talk about Ripple, I'll often hear them say it's trying to replace correspondent banking. Is that essentially what Ripple is trying to do? Is that what the mainstream value?
That is one very obvious use case for the Ripple protocol, definitely. What I can say about that is Ripple enables point-to-point settlement, and it does enable point-to-point settlement across currencies. So that is one thing that is a little bit different between the Ripple protocol and a payment system that would use Bitcoin. So if you were trying to do cross-currency transactions using Bitcoin, for example, if you're going like dollars to euros, you'd have to go dollars to Bitcoin, Bitcoin to euros. With the Ripple protocol, you can do directly dollars to euros, or between any other currency. So it's in our view, a little more fluid for transacting in the cross-border situation. And what Ripple does do, because it's point-to-point, because it permits direct settlement, it enables any bank potentially to transact with any other bank across borders. So at this point right now, we have one bank in Europe that's integrated the Ripple protocol, Fidor Bank in Germany, and there are 2 US banks who have now begun integration work with the Ripple protocol. And what the advantage is for those US banks is that up until now, a smaller bank really didn't have direct access to the global financial system. If it wanted to send money across borders, it had to go through one of maybe 6 global banks that have the physical presence in many different countries to send money around the world. So accessing that network is very, very expensive. It can cost $1 million just to set up a correspondent account to have access to the global financial system with one of these correspondent banks. So for the smaller banks that are integrating the Ripple protocol, they can now offer their clients effectively correspondent banking services. They can send payments to Europe directly and do it and directly compete with the largest banks in the world and do it faster and more cheaply than those banks are able to do it. So it's not speculative. It's really happening right now today that this technology is enabling faster and cheaper payments.
So Anne, from a policy perspective, what's the value that cryptocurrencies bring to the mainstream?
Well, assuming that they can comply with the international standards established by the FATF and with the national legal frameworks in various jurisdictions, including the United States and our Bank Secrecy Act, and Jen will talk to that, we very much favor financial innovation that supports transfers that are more efficient, less expensive, and that can bring more people into the regulated financial sector. I mean, there's a tremendous value in that, both in terms of economic policy and in terms of anti-money laundering, counter-terrorist financing policy.
So I'll ask all of you, so what you've all identified disrupts certain incumbents. How are the incumbents reacting?
I could start to speak to that. So we really don't view the Ripple technology as disruptive. We actually view the Ripple technology as extremely constructive. And the reason why we do is I think there's wide acknowledgement by all players in the financial services industry that payments are too slow, they're too opaque, and they are too expensive. And that is certainly not a Ripple Labs perspective alone. I mean, the Federal Reserve has been doing this series of payments improvements, a call for faster payments papers. They just came out with their most recent one last month, and the message that they are consistently giving is that payments need to be faster, they need to be cheaper, there needs to be more access to cross-border payments for the average person. So all of these things are
Implicitly, what they're saying there is that the incumbent systems have not delivered on that.
well, no, I would say the incumbent systems, the current correspondent banking network as it exists today, does work. A lot of the technology that was built in the 1970s, and I think there's recognition among those incumbents that something needs to change. So we haven't. Our experience within Ripple Labs is not that the larger banks are uninterested in this technology. Quite the contrary.
So Patrick, what do you see
Yeah.
Incumbents?
So I think that for most of the people who are incumbents in the space, whether they're in any way acting as like custodians or registering kind of deed of title, or if they're sitting anywhere in chain of title on any sort of asset class, you have to look at the blockchain and think to yourself, is this something that somebody else in Silicon Valley is going to go build a company out of a dorm room and eat my lunch? Or, secondly, is this something that could improve my margins internally? If I start using Bitcoin internally as a way to record assets, record deed of title, to do those things and make those transactions happen cross-border, globally, instantly, but in a zero trust environment, then what does that open up for me as far as like new opportunities, new potential? And I think that's what most people are seeing, is that you talk to these large incumbents, the banks, people who are supposedly being disrupted, and I think that they're taking a longer view on things, and a more strategic view, and saying, well, maybe this could disrupt us, but if we just bring it inside the house here, then we'll just disrupt ourselves. And that's disrupting yourself is a lot better than being disrupted by somebody else, right? So let's do that. And I think that's what you're really seeing happen right now. And I think it's interesting when you talk about like the consensus model that Ripple is built on, and Bitcoin, and how they kind of can work together, and how they vary in certain ways. And when you see the evolution of financial data, you start with like bank-to-bank transfers, right? Very siloed data, and it's one-off transactions bank to bank. And then you have something like Swift, which creates kind of like ways to move data through this portal to other siloed bits of data. And then you have something like Ripple with this consensus ledger, where you're essentially creating a web of trust, right? You still have to trust that all the people on the nodes have the dollars and the euros and the yen, so that when you make that instant transfer, I can get it at the end, but you've created a connective tissue around it. And then further down the chain, you have the blockchain, which is you've completely broken out trust entirely, and now you've taken the data out of the silos and published it out into the cloud completely. And I think that's the spectrum you're on. So for some people, they may find that it's a little more comfortable to sit a little further down and do the consensus model and like work through this, or they may find that this zero trust environment is expensive, and it's not like it's not for us, because we just want super fast settlement, and that's fine. And they'll find the right technology to meet their needs, I think. But it's definitely something that you hear consistently from the people who are supposedly being disrupted. You see the New York Stock Exchange invest in Coinbase, right?
That's right.
Like, so they're obviously taking a long view on it.
Yep. So, we've been talking about instantaneous cross-border payments, which is something that I'm sure perks up the ears of regulators and folks at the Treasury.
And policy folks.
And policy folks. So let's talk about, if we're going to have a regulatory regime at this, it's going to have to be international in scope, perhaps. But let's talk first about, Anne, what are the international concerns that this raises for you?
Well, I think first and foremost is the money laundering, terrorist financing, sanctions evasion risk that comes when you have a global system that is anonymous, in the sense that while the transfers themselves may be transparent on the blockchain, if they're not tied to a real world identity, which they are not necessarily tied to, then you have a potential for complete anonymity. And so both identifying people who are accessing it, using it, and then eventually cashing out and interacting with the current regulated fiat system in jurisdictions around the world becomes an issue. We don't want to see a system develop as an alternative to a very carefully and thoughtfully risk-based regulated global financial system under international money laundering and terrorist financing standards that allows regulatory arbitrage and that creates weak links around the world for entry into the regulated system. So on the one hand, we very much are supportive of financial innovation, to have more efficient transfers, to bring more people in, but we really want to see compliance with a very established global set of standards that the FATF has established. And first and foremost is customer identification and verification, and monitoring and record keeping, and reporting of suspicious transactions under the criteria that have been agreed to by the international financial system.
So, when you have closed proprietary systems that are run by companies, you can see how you could apply such a regulatory framework, how to enforce that. It becomes a little bit more difficult when you have an open network sometimes. So how do you deal with that?
Well, that's true, and I think one of the issues that jurisdictions around the world are confronting are the regulatory challenges. But these international standards in the first place do not apply to individual users. They apply to the FATF standards require countries to implement anti-money laundering, terrorist financing controls on financial institutions, and also designated certain other entities that are not formal financial institutions that are designated non-financial businesses and professions. But financial institutions are defined by activities. It's all activity-based, and it's all conducting financial activities on behalf of third persons. So it's not like there's any requirement to impose regulation on the Bitcoin protocol or a Ripple protocol, but when financial institutions are conducting defined activities, whether it's money transmission, accepting deposits, running a payment system. These are some of the categories of financial activities that define a financial institution under the global standards. Then money laundering, terrorist financing controls do apply, and that's not nearly as difficult. If you're setting yourself up in business in a jurisdiction to use these protocols, then you are a node that is engaging with the fiat system, and there are established criteria and requirements set internationally that then the particular jurisdictions around the world implement through their own national legal frameworks. So that responds to the money laundering, terrorist financing, and sanctions implementation. There are other issues that I'm not really particularly qualified to speak to, but the Bank of International Settlements, for instance, is another standard-setting body, and it is concerned with, payment systems integrity, cybersecurity, network security, safety and soundness, all of these issues that in this country are dealt with more on a state-by-state basis. But I think that probably there will be some push if this industry is to, obtain trust and to obtain, greater traction and legitimacy for these kinds of issues, given that if it's going to function like a payment system, even if there isn't a centralized entity, how are they going to meet those requirements? And I would think that, again, just as with the anti-money laundering, counter-terrorist financing controls, you apply those kinds of requirements not in the ether, but to the specific businesses that are engaged in accepting funds, whether it's or value that substitutes for funds, as we say in terms of our regulatory structure here, whether it's fiat currency or virtual currency. Is there enough, money in the bank or in whatever the trusted, repository is to handle, the consumer's needs and what happens if there's a failure, and how do you protect. We've already seen around the world kind of the cyber hacking, what system requirements to impose to protect against that. So I think that, yes, it developed as a very individual-based type of thing, and individual users will be outside kind of the systemic requirements that are for businesses, although certainly if they do bad activities as individuals, either terrorist financing or money laundering, whatever, that's also controlled by criminal law, you're going to need to have the kinds of protections in place in some fashion for it to take off.
Yeah.
So let me, go ahead.
No, what's interesting is, when I hear that, it just reminds me, whenever you inject trust back into the system,
Yes.
inherently regulation will follow, right? And so the best systems, and I tell entrepreneurs this, I'm sure you do too, Jerry, I think we're of a like mind on this. When you're building systems out there using the blockchain, these open technologies, figure out ways to build them responsibly, right? And figure out ways to build them with as little trust as possible required for the end user, right? You have less concern as a regulator about safety and soundness if you can prove irrefutably as a consumer that all my funds are held safely, or they're not held in trust by somebody else, right? If I have complete access, or I know that you don't have, as the exchange, exclusive access to my Bitcoin, then I'm not as worried about the safety and soundness of those assets.
So I'm going to get a little wonky here.
Please, that's your job.
So, I mean, the reason that we have some of these capital requirements is because there's an information asymmetry problem, because you can't tell whether the money is there or not.
Yes.
When you have a provable system, well, now you can tell. So are you saying then that we don't need these regulations anymore, or just that it's easier to comply with these regulations?
I think so. So before I went down this crazy path of digital currency and Bitcoin and all that, I was a telecom attorney. And so when you look at the history of telecom, you have systems that were very, very regulated, and there's just one or two. There was AT&T basically, right? And it was heavily, heavily regulated. It was a common carrier. They had to do a bunch of different things, different types of regulations for different types of concerns. Heavily, heavily regulated. As that broke apart, and as those services unbundled, the regulatory environment had to shift and accommodate that sort of unbundling. And the regulatory requirements now are very different today for the telecom industry than they were, 20, 30 years ago. Now we talk about net neutrality, right? Back then we talked about common carrier regulation. So things have changed then to accommodate these more open networks. And I think in finance and banking, you're going to see that same evolution. You're seeing it occur where you have regulations that are built for these kind of common carrier, too big to fail institutions. And you're going to see it have to evolve a little bit so that, it kind of, everybody is meeting the needs of each other. People who are building services using the blockchain can build responsible services that serve the goals that you're trying to attain, which is stopping illicit funding and things of that nature. And at the same time, the regulations are going to have to adapt a little bit to understand and accommodate this unbundling effect of all these services. Instead of just being in one bank, now being available to me on my phone here, and I can record my deed of title there, and I can send my, I can pay for my car, and it's an embedded payment when I, open the door to my car and I turn it on, and there's all this crazy stuff that people are building. So the regulations will adjust and the people will adjust.
Karen?
I'd just like to pick up a little bit on what you were saying, Patrick, about whether or not these technologies enable compliance in a setting where there's trust, which is obviously where my company's focus is, right? Mm-hmm. So on the banks and financial institutions that do have these regulatory requirements, it's interesting to see that sometimes these open protocols actually make compliance more straightforward and easier. Mm-hmm. So like with the Ripple protocol, there's point-to-point settlement, which eliminates the whole series of hops between various financial institutions that currently happens today when a payment is made across borders. Those series of hops are completely opaque, and the sending institution doesn't even necessarily, usually doesn't know what other institutions that payment will pass through before it reaches the recipient. So to be able to settle things point to point creates much, much, much more transparency, which has implications, of course, for the kinds of anti-money laundering issues that Anne and her work at the FATF is focused on, it also has good implications, very positive implications for things like the new fee pre-disclosure rules under Dodd-Frank. I honestly don't know how any bank can comply with those rules if they're not using Ripple. I mean, I'm not saying that to
Nothing sells like fear. Just
right. If you don't know in advance where the payment is going and what fees are going to be added to it before the recipient gets it, it's extremely hard to comply with pre-disclosure. And my understanding is that what banks are doing in order to comply is just raising their fees so that there's a cushion, so that they don't get caught under disclosing the fee, which is really the opposite result of what everyone was hoping for with that regulation. So the banks that we're seeing that are integrating the Ripple protocol are really excited about the fact that because the settlement is point to point, they can pre-confirm what the fees will be and disclose it to their customers in advance. And it's the actual amount. It's not a guess.
So, we've been talking about having a cohesive international framework, and you mentioned state by state a minute ago. In the U.S., we have 50 different.
48.
Well, always a stickler for the details. We've got 48 plus 2 out there states that have not completely different. I take that back, but different enough regimes for licensing where you have to navigate each of those, and that generates friction in what is essentially a global market, at least a national market. So, how do we deal with that? Is that something that's going to stop this cryptocurrency from entering the mainstream? I'll start with you.
I don't think so. I think you're already seeing an effort by the states through the umbrella organization of the Conference of State Bank Regulators, which is the umbrella organization that in the states also regulates money transmitters, looking at, they formed a task force, and then on December 16th they issued a policy statement and an outline of the types of issues that all of the state should consider in regulating virtual currency exchangers, money transmitters, administrators, depositories, hosted wallets. They listed the types of entities that they thought should be regulated under the state concerns, which historically have focused on consumer protection, safety and soundness, payments, and network security. And they articulated as one of their first kind of principles a need to support innovation and to develop a consistent framework across the states. They pointed to the desirability of establishing consistent licensing standards and using possibly existing databases. The National Mortgage Licensing System database is one that they're looking at. I think the director of FinCEN can talk about efforts to coordinate state supervision and enforcement, but I think, when the money transmitter laws were developed in the states that regulate and license, there wasn't an internet, and there was this kind of balkanized development. Now there's very much an awareness of internet-based payments, national payments and global payments, and a need to facilitate financial innovation by having consistent regulatory regimes across the states and I think this is a good beginning. I think you also see New York, the Department of Financial Services, fleshing out this type of what this would look like in practice with the so-called bit license proposal that's still in draft and is receiving comments. The Conference of State Bank Supervisors Task Force consisted of 10 of the most interested states, and New York was part of that, California, Texas, some of the other leading ones. And I think that they're soliciting comments. I think next step is likely to be a model law if you had traction for that. And I think interestingly enough, the virtual currency industry is creating, I think, a whole new kind of ecosystem for and pushing the need for that and for innovation and also a consistent regulatory approach that we didn't see before. Before, with the traditional money transmitters, for instance, you had a couple of really big ones. They had handled it, over time. Now you have a bunch of startups coming up and saying, this is really onerous, and not only that, but we're looking at this whole thing as an experiment, and we're, operating and kind of the back and forth between new entrepreneurs and a heavily regulated financial sector, and that, on the one hand, friction but also positive engagement. So I think that it's a very fertile area, and I think that certainly both at a national level and state by state, governments and the private sector want to support innovation. They want to be centers of entrepreneurship, but we also need to have the protections that for both consumers and for our payment system.
So I definitely agree. It's a good beginning. But Patrick, Karen, do you think that the CSBS policy statement and framework and the BIT license is going to get us to a consistent 48 state, not 50?
And we'll all sing Hakuna Matata, and we hope for consistency, right? You hope that you can, send one application through the NLMS, and you then apply to every state, and then you get a license, and it's everything is great. That's not usually how it plays out in practice, right? There's always going to be little differences here and there, and it's going to be a little bit hard. But again, it takes me back to the telecom days and the PUCs, the Public Utility Commissions, and things like that. If I want to string copper wire, right, and I want to do it in Idaho, then I'm going to have to go to the Idaho Public Utility Commission and deal with the FCC, and it's the same multi-layered approach. And if I want to string it across 2 states, then I got 2 states to deal with and all that. But if I'm Skype, I don't have to go to the Idaho PUC to figure out whether or not I can deliver peer-to-peer VoIP services, right? And that played out a certain way, and there was a reason for it. You did have to go to the FCC, and they did fight, and it was Pulver, and they fought. And you wonder, with some of these services, what are you exactly trying to regulate here? Again, you're trying to regulate from a state level trust, consumer trust. Can I put my money in this institution, which in the past, like copper wire, was inherently local to that state, local to that community? And can I trust that I'm going to get it back, right? And that's primarily 98% of what the states are concerned with, except for New York, which also wants to do money laundering too. Some people laughed. So again, you wonder, is that maybe the right framework here? And I want to let Karen answer that too a little bit, and maybe Jerry, because you have experience with.
Well, but I'm the moderator here, and I just want to ask.
I want to jump in.
Let me just ask Karen one thing, and then I'll come back to you. I just want to ask Karen. Well, how long do we have to know whether it's working or not, and what's the alternative?
Well, so just my own background is that I worked at the New York Fed for many years, and that is so my biases come from that time. And so coming from that background and also seeing what I'm seeing in the work I'm doing now, I have to say my perspective is that payments are the backbone of the financial system, and that we have a national economy, and the idea that we are going to create a fragmented payment system by state just makes me sad. Like I think America should be one economy is how I feel about this. So if the state regulators can pull together and create national standards, that's great. And I've been really encouraged by the kind of engagement that I saw in the BIT license effort and also with the CSBS. But I just really, really strongly feel that these new technologies, whether it's Ripple Labs or a Bitcoin technology, whoever is doing this is the future. And this is an important development for our economy and our place in the world. And I just really think that this is something that should be, the standards should be articulated nationally.
Ann?
And that actually segues back into what I wanted to add, and that is that from an anti-money laundering, counter-terrorist financing perspective, every single one of those states essentially says that if you comply with the FinCEN, the Federal Bank Secrecy Act, that's our anti-money laundering, counter-terrorist financing law, regulations, then as far as we're concerned as a state, you comply with our needs. So that is, in fact, in that context,
Right.
A de facto national standard. I think that the fact of the matter is we on the one hand, did get rid of regional and state banking requirements, that was one level, but we still have a system where banks are regulated in part by the federal banking authorities and in part by the states. So the idea that you're going to have a payment system that is different from a kind of state-based protective system, I think I do agree that we need to have consistent standards. I think that the states recognize that, and I do think that there are coordinating mechanisms that weren't there before, and that there's more of a private-public partnership on that.
That's true.
All right, I think we have a few minutes for questions. So if anybody's got a question, raise your hand up high, and I think I see one right here. Yes, sir.
With respect to the operation of the infrastructure in the blockchain and the relative opaqueness of what is going on amongst the miners and the guilds, while waiting for or looking for, hoping for major institutions to start taking advantage of this technology, do you think there'll be a push or a pull for some kind of transparency, registration, identification of who is doing how much of the mining at any particular time? Or
So when you say opaqueness, I think you mean it in a different way than maybe I think of it, right? Because all the mining activity is public, right? I mean, when a miner mines a block and they add it to the chain, they broadcast it out, so they know how many fees, what the fees they are taking, what the block reward was for them, essentially their total compensation for adding that block to the blockchain. You can see all the transactions in the block. You even have probably a little bit of location information about them and things like that. But you might not know exactly who that individual is or that corporate structure or whatever. And the question, I guess, you then go back and you ask yourself, as you say, why does it matter? Does it matter to me that my transaction to Jerry went through somebody in China, or if it went through somebody in California or Ontario? Does that matter to me, right? Does it matter to me as a consumer? Or does it matter to me as two businesses interacting? I know that it's cleared and settled, and I don't have to trust the miner to make sure that it cleared and settled. So the question is, why is identity relevant, and what aspect of identity is relevant in that context, right? And usually when you're talking about the settlement person, the Visa, whoever's processing it, that identity and that corporate structure and the type of transparency you're talking about is relevant because I don't trust you, right? Or I shouldn't trust you with my money because it's not going to get delivered to Jerry. There's misdelivery and all these other counterfeiting, whatever. But if I don't have to trust you and my transaction gets through, then I think that transparency is enough. And you also, of course, know the size of that mining guild, you know the size of that mining pool, and all those different things. So,
Other questions? Okay, right here.
Hi, I'm Brian Kelly. I'm curious, I represent kind of the Wall Street voice here as an investor in Bitcoin. I'm curious, as you're looking into the policies and how you're developing Bitcoin or Ripple, it seems to me that there's really no intrinsic value to the currency at the core of all of this. So when you're developing, do you think about the investors in it? And really right now, Bitcoin operates on a greater fool theory, which is fine until you run out of fools. But what happens then? Are you guys planning for that at all?
So Jerry, you want to? No, I'm joking.
So I'll answer just a little bit. This idea that Bitcoin has no intrinsic value is always a funny one to me.
Yeah.
Bitcoin is a network that allows you to send value instantaneously globally. That's valuable. That's the intrinsic value of Bitcoin. Like, what's the intrinsic value of email?
Well, but there's.
Okay, we're gonna have. This is the panel's gonna answer the questions. Okay.
So and that's right. That's exactly right. So there's value in the network. There's value in the blockchain. Having this river of information running through the internet is incredibly valuable. And the Bitcoin itself, the coin, even though there's no real coins in Bitcoin, but sorry, I didn't mean to go there, but the coins, right? That's your ability to sign instructions and add data into that river of information that runs through the internet. That's valuable. There's some real value there. And there's proof of work. There's actual mining and electricity and hard costs that go into securing that network. And that creates real value in that token, right? That token means something. It means I can access this network, I can sign an instruction, and that instruction can operate on the blockchain. That means something to people. And it will become, hopefully, and the speculators believe that access and that instruction setting will become more valuable over time. Ripple is a little bit different.
Yeah, and I'd agree with many of the things that you're saying.
Yeah.
I do have a somewhat different perspective, and again, I think this comes a little bit from my Fed background and just like thinking about money a lot. But what was that? Huh?
No, nothing. It was
You've got mail.
Okay.
phone.
Phone?
Yeah.
Oh, was it a You've Got Mail? Oh, that's cute. So
We are at a tech conference,
Right.
right? I mean, I didn't know it was like 10 years ago.
We were talking about closed proprietary
well, when you
networks
talk about tech and
versus.
money, you could be talking 10 years ago. But so just to circle back to what we were talking about is the intrinsic value of these virtual assets, right? So you can think of like, so what is the value of the money that we think of as fiat currency, right? Like you could say it has no intrinsic value either, right? But we are very comfortable with the idea that it does have value. And so where does that value come from? There's at least two places, and I'm like happy for people to offer more, but one is as a store of value, and one is as a means of transacting. And just the way, like, this is just my personal way of thinking about this, but like if you think about Bitcoin being created, it was like the first virtual asset. It was the first asset that could exist electronically. And it's really, a great store of value and does that well. And if you analogize it kind of to gold a little bit, like gold is a great store of value. Gold, the value of gold goes up in times of uncertainty. Bitcoin was created in times of uncertainty. It was created like close to the time of the financial crisis. It's gold is volatile, Bitcoin's volatile. But it doesn't mean that it's valueless. It just means that it's serving a certain function, and it's kind of optimized for that. It's not. It's a little clunky to transact with. Gold's a little clunky to transact with, but people do it all the time. With the virtual asset that's part of the Ripple protocol, we call it XRP. So XRP just serves a couple of functions that make the protocol work well. One is that it is the source of the fee for transacting. So a small amount of XRP is destroyed every time you transact. The purpose of that is to discourage spamming attacks. That it's designed to feel free to the person who's transacting legitimately, but if you're trying to do a denial of service attack, it will become rapidly too expensive to do. It also serves as a bridge currency between other currencies, so it enhances the interoperability of the protocol. So when I look at XRP, I think of it as more analogous to something like the dollar, which is kind of optimized for transacting. If you think about how people use the dollar, like if you get a bunch of gold, you put it in a vault. If you get a bunch of dollars, you don't hold on to them. You pretty much quickly, start transacting in them. You don't really, most people don't put a lot of dollars in a vault. They start investing them or they trade them for other things. And the value of the dollar is really related to how useful it is for transacting. So that's just like my personal way I think about these two assets.
So I want to move on to getting one more question, but I will point out that we didn't answer the gentleman's question, which is, do the developers think about the investors as we're developing? So that's a question maybe Gavin can answer later when we mingle.
Generally, no. I don't think that's yeah.
One more question? Oh, back there.
My name is Bill Leginski. This is, I guess, directed towards Anne, I'd say. It seems like a lot of what Anne and Karen, the points you brought up, are kind of the value proposition of Bitcoin and Ripple in terms of, I guess, reducing regulatory friction, which is something I hadn't thought of before, but I thought it was a great point you made about the pre-transaction knowledge, and then you were talking about MSBs and kind of standardizing them. And what struck me is that my question is, number one, who government-wise, I guess, would be best positioned to kind of evangelize this, and how would you go about it? So it becomes part of the discussion in the political arena. I'd say in terms of helping people see. I mean, this could be the killer app of this technology, couldn't it? In terms of the government backing this kind of technology could be reducing the friction of regulatory, compliance.
So, I mean, I agree that regulatory acceptance is basically key to the success of this technology, for sure. And that's one reason why I spend a very large amount of my time talking to different regulatory agencies. So yes, I couldn't agree more. I guess, yeah. Yeah.
So you're talking about getting regulatory acceptance
right.
of technology, but doesn't the technology facilitate the regulator's job? Is that what you're both saying right now?
Well, I mean, I
Not
think
what I'm saying.
I think I should let Anne speak to that to some extent, but I did just want to have like one last point to your point. I mean, I think, a technology is a technology, and there's usually, and regulators have legitimate concerns that they are trying to address, right? So there may be some regulatory concerns that can be addressed technologically, but chances are there's still going to be a need for rule sets. I will say there are, I see a number of benefits for the technology, for the Ripple technology that I'm most familiar with. So like the Dodd-Frank example is one. Another is I think what we've been talking about a bit is the fact that it's point-to-point across borders. So like a lot of the concern that people in the anti-money laundering world have around cross-border transactions has to do with the fact that those transactions are inherently opaque because they go through a number of hops, and like in those hops, that's where a lot of funny stuff happens. Like, when you've seen like really, really significant violations of sanctions rules, it's because people in the series of hops between banks, people have been stripping information out of payments of the payments messaging and obscuring the origin of payments. So,
but that's contrary both to a specific international standard that requires beneficiary and wire transfer information that goes through financial institutions, so that standard addresses precisely that issue of having the information at hop to hop to hop to hop so that you do have the transaction trail. And it's also contrary to our own.
Right. Yeah. No, I'm not saying the people who
did
that were breaking the law.
It's not like there isn't an existing framework to address that opacity. If there's implementation of what should be in every country's domestic framework and certainly is in ours, then you don't have that opacity. But But with respect to whether, you know, the government should drive the adoption of a particular technology, certainly, you know, that's not the case at this point. I think probably there's general awareness that the Federal Reserve Board is looking at various models and methods for making the payment systems more efficient, and digital transfer mechanisms, I think, is their terminology, which could refer simply to electronic versions of fiat currency, or it could refer to decentralized virtual currency. That remains to be seen, but I think there's a lot of interest in that. You know, from a perspective of, is it helpful to have a trail that's electronic? Yes. Does the Treasury Department and the Internal Revenue Service favor electronic filing and say for income tax and refunds, or for the delivery of social benefit networks? Yes. So, you know, to that extent.
You were telling me earlier that the U.S. engages bilaterally,
Yeah.
On cryptocurrencies.
Certainly, and also regionally.
And what does that mean? What do you exactly tell your counterparty bilaterally?
Well, I don't want to step on Jen's lines, but we really think that that we have developed in this country a risk-based approach that makes a lot of sense, which is that we focus, and this is strictly about money laundering and terrorist financing controls, but we look at money transmission. That's the regulatory framework, but we look at the nodes that intersect with the regulated financial sector. So we're looking at administrators of convertible, centralized convertible virtual currency, and exchangers and hosted wallet services, businesses that are at that intersection of fiat currency and virtual currency, and place the national regulatory framework for money laundering, terrorist financing, the MSB framework there on that, and that's where we're focused. I noticed that when Karen talks about the Ripple protocol, she's talking about bank access, and banks are highly regulated. They have these requirements. There's a very developed supervision and enforcement system. But it's not just banks that are the gateways for the Ripple protocol, and so those non-bank entities, including entities outside the U.S., would be of concern to us. We want to see all jurisdictions implementing appropriate
it's interesting.
regulations.
I am.
And this will be the last word, because we have to wrap up. I'm being told.
Timed it perfectly.
Awesome.
Thank you, Jerry. So. Yeah, focusing on the critical control points, I think, is good, no matter what those critical control points are on the network, of course. I think every crisis is an opportunity, right? So we have this, again, it's happened in other spaces before. You have these technological disruptions happening, and usually when that happens, things are democratized, things are unbundled, and things get a little bit weird. So you have these things like the travel rule, which are designed for the SWIFT network, right? For me, when you look at the blockchain and you look at these peer-to-peer technologies and these different approaches, it's an opportunity. For example, take identity. This is a great opportunity for all of us to rethink what identity means in a digital world, especially for financial transactions. And we should really, really be focused on that. Not to replicate what existed in SWIFT encoding, but to create a new framework that allows you to meet your goals in a better way. So the idea of just in time, just what you need financial information, that's a great idea. Let's use that. Let's figure out what the bad transactions are first before we collect everything you've ever known about yourself and transmit it over the network, right? That's a great way of thinking about how we can bridge the gap here, in my opinion.
All right, optimistic.
Try to.
Thank you all so much for listening to us, and thanks to the panelists.